You're listening to the Tax Insights podcast, where the professionals at Hawkins Ash CPAs break down complex tax topics into bite-sized how-tos. It's easier for individuals to do tax planning before the end of the year than it is after. In this episode, Jeff Dvorak shares how individuals can use stock sale losses, charitable donations, as well as retirement plan and health savings account contributions to help offset taxable income for 2022.
As we talked about last week, now that the election is over, it looks like we're going to have divided government in Washington for at least the next couple of years. And what this normally means is there's not a lot of tax changes that'll happen.
All right, so let's start off with the effects on the stock market going down.
Sure. So, this has been a tough year in the stock market. So my guess is that, people probably have unrealized losses on some of their investments. So here's the thought from a tax point of view. If you sell any of your stocks at a loss, those losses may be able to offset some of your income for 2022. Now, there's two things that you have to be aware of here. The first thing is that you can only use capital losses to offset capital gains and an additional $3,000. So this essentially means that you can only offset $3,000 of your non-capital gain income. Any other excess losses are just carried forward. Second, if you sell a stock at a loss, you need to satisfy the loss sale rules in order to be able to take that deduction. A lot of people think you can sell a stock one day and buy it the next. Well, it's not the case. So what the rules essentially say is that you cannot take a loss if you purchase that stock 30 days before you sell it, or you repurchase it 30 days after you sell it. So you got to be careful of those 30-day rules on each side of the sale. Now, the rules are more complicated than you think in this area, so you want to discuss that with your accountant or your investment advisor.
Right. Now, let's talk about, does it still make sense to plan around charitable donations?
I think it really does. So, it's been more difficult than it has been in the past since the standard deduction was increased a number of years ago. And that standard deduction is even going to go up higher in 2023 due to inflation. Now, the plan here would be to make large donations in certain years, take that as an itemized deduction, and then take the standard deduction in other years. This can be done via large gifts, or donations to donor advised funds where you make a large donation in one year that can be used in future years, or even for some families that are a little more on the wealthy side, setting up family foundations.
So there's an additional planning for people over the age of 70. Is that correct?
Yeah, and this one is really, really neat. So if you're over 70 and a half, you can give a donation to a charity and get a deduction even if you don't itemize. You just use the standard deduction, right? So this is called the Qualified Charitable Distribution, or QCD. When done correctly, the withdrawal from your IRA will not be taxed and you will not get an itemized deduction for a contribution. So this works well for those over 70 that are taking the standard deduction. Now, there's some rules here that we have to follow. Number one is that the donation, it has to go right from your IRA to the charity. It can't go into your checkbook and then you send it to a charity. It's got to be a direct transfer. And it can only be done after a person turns 70 and a half, not in the year they turn 70 and a half. So it's got to be done after your 70 and a half mark. You can do this for up to $100,000 a year. So it's really a nice planning tool for those that have a little bit of wealth and even those that don't. And contributions from 401k plans and donor advised funds, these kind of things don't qualify. So it has to be through an IRA and it cannot be through a donor advised fund. But a nice advantage of this is that the donation to charity also counts towards satisfying the required minimum distribution that many people have for the year.
So Jeff, let's move on and talk about retirement plans. I know we've done this in the past. I'm sure this continues to help, correct?
Yeah, I know it's been a tough year for a lot of people, like we talked about earlier, but continuing to save for retirement is really important. If you haven't started, this is the time to get started. Start with a small amount and increase it every single year. It's easier to increase once it's started, even if it's just, 1 or 2%. If you're already funding for retirement, remember the limits are increasing as we get older. and make sure you take advantage of those catch-up provisions.
Yeah, Jeff, a lot of great information. Last question here, though. Let's talk about an HSA or health savings account.
Yeah, from us talking earlier, I'm a big fan of these accounts, since you can contribute money today and get a deduction this year, but you don't have to spend it on medical expenses until a future year. For most of us that don't itemize, any medical expenses paid are not tax deductible. But if they're paid from the health savings account, then they are. It's like having the government pay for part of your medical costs. It's a good deal.
Absolutely. Jeff, again, how do listeners connect with the team over at Hawkins Ash? Because now is a time as tax season is right around the corner.
Yeah, and it's a lot easier to do planning before the end of the year than it is after. So go to our website, hawkinsash.cpa. Follow us on Twitter or even like us on Facebook.
Yeah, Jeff, hey, we'll talk to you next week.
This has been Tax Insights, presented by Hawkins Ash CPAs. Learn more online at hawkinsashcpas.com. Hawkins Ash CPAs, part of your business, part of your life.